Hey everyone, if I ask you what is the valuation of a company, 9 out of 10 people would jump to check the PE ratio. And sure, it's a good starting point. But what if I tell you that in many sectors, using the PE ratio can give you the wrong picture? Take banks for example, or even hospitals. These companies might look expensive or cheap on PE, but that number does not actually reflect how their business operates. In fact, relying only on PE can sometimes mislead you into thinking a great company is overvalued or a risky one is cheap. While PE is a great metric to gauge valuation and most widely used, it has its own limitation. PE ratio only works well when profits are predictable, depreciation and debt are low, and capital structure is stable. But most sectors in India, especially the capex heavy ones like infra, energy, real estate, they don't meet these conditions. That's why in this video, we'll go sector by sector and understand what is the right KPI to value each type of business, why PE ratio does not work for everyone, and how to use metrics like price to book, EV to EBITDA, EV to sales, etc. with real Indian stock example. So if you're serious about long-term investing, this video will help you avoid one of the most common valuation mistakes. Alright, let's get started. Okay, let's start with a sector that almost every investor look at, banking and financial services. Now most people instinctively look at PE ratio while evaluating any stock. But for banks, PE ratio can be quite misleading. Why? Because banks don't operate like traditional business that produce and sell goods. Instead, banks earn money through interest spread, the difference between the interest they earn on loan and the interest they pay on deposit. And to earn this interest, they need a strong balance sheet. So their profits are directly linked to the size and quality of their assets, not just revenue or margins. That's why for bank, the price to book ratio is more appropriate valuation metric. What does price to book actually tell us? It compares the current market price of bank to its book value or net worth per share. In simple terms, it answers how much are you paying for each rupee of equity in the bank. Now in case of PE ratio, you can look at the earning growth, and high earning growth companies will command a premium valuation. But in case of banks or NBFC, how do you know which bank or NBFC is trading at expensive, cheap or fair valuation? For instance, ICICI command a price to book of more than 3, whereas IDFC First command a price to book of less than 1.5. Within small finance, let's say Equitas command a price to book of 1.2 to 1.3, and in same sector, AU Small Finance command a price to book of 3. If we take NBFC, let's say Home First, it commands a price to book of more than 4. Why there is such a stark difference in price to book? Here earning growth is obviously an important parameter, but more than that, you need to look at ROE, that is return on equity, along with asset quality, deposit and advances growth. A bank or NBFC that simply grow its earning with a weak credit underwriting process would eventually end up with high NPA and then losses. A great example is Yes Bank. Let's take example of ICICI Bank. It has one of the best ROE in the industry along with one of the best asset quality. Plus its deposits, advances and earnings have grown consistently. No wonder it commands a premium valuation. In case of IDFC First, although its deposit and advances are growing at a fast rate, but it is still struggling with low ROE. And its asset quality has been volatile, especially with recent microfinance exposure. So the market is not paying it a high price to book multiple. Equitas used to trade at a higher price to book multiple, but in last 1 year, small finance sector witnessed massive problem in asset quality due to their exposure in microfinance sector, which is an unsecured loan. As a result, its earning fell down and valuation got derated. Then Bajaj Finance always command a premium valuation with price to book of more than 5. The biggest reason is because it is one of the most profitable financial institution with one of the best ROE in the industry. Plus it is growing its AUM at a very fast rate and is able to maintain asset quality. However, if situation turn around and ROE asset quality improves for some of the banks, valuation can re-rate. And likewise, if asset quality deteriorate and ROE fall in future, valuation can de-rate. Just to summarize, the right valuation metric for bank and NBFC sector is price to book. And to understand why some banks or NBFC commands a high price to book whereas some command a lower price to book, you need to look at ROE, asset quality and overall history of that institution in last few years in terms of lending practices. Maybe I can do a separate video on important KPIs that you need to look at while evaluating banking and NBFC sector. Next, look at hospital and healthcare service sector. Hospital and healthcare service sector looks like a great business. Rising healthcare demand, high entry barriers, and long-term structural tailwind. But when it comes to valuation, the PE ratio is not often the right lens here either. Why? Because most hospital business are capital intensive. They invest heavily in infrastructure that include land, building, medical equipment, and these assets depreciate over time. Also, they often raise debt to fund expansion, which means high interest cost. Now, if you look at net profit, which is what the PE ratio is based on, you're looking at a number that's been reduced by depreciation and interest expense, even if the business is fundamentally doing well. That's where EV to EBITDA comes in. What is EV to EBITDA? So EV stands for enterprise value, which include market cap plus net debt. So EBITDA is your earning before interest, taxes, depreciation and amortization. It stripes out the non-operating expenses to show you the core operating profitability. This metric tells you how much are you paying for the operating earning of the hospital without getting misled by accounting cost or capital structure. Let's take two real-world examples. Apollo Hospital, which is one of the largest player in India, trades at a PE of nearly 70, which sounds very expensive, but if you switch lenses and look at EV to EBITDA, it is around 25-26, which is more reasonable for a company investing aggressively in expansion and new age healthcare business. Then Max Healthcare, another focused hospital chain, also shows the same trend. A very high PE multiple, but a more grounded EV to EBITDA multiple. The key here is that hospital profits can be lumpy, especially during the high growth phases. Many of them go through a J curve. First they invest heavily in capacity, then comes a gestation period, and finally profits start showing up when occupancy improves and ARPOB, that is average revenue per occupied bed, rises. So what should you track alongside EV to EBITDA? First is occupancy rate. It should be ideally above 60 to 65%. Second, you should track ARPOB, that is average revenue per occupied bed. A higher ARPOB means more premium offering. Third is EV to EBITDA margin. Healthy operators aim for 20-25% margin. And fourth is expansion strategy. Are they over leveraging or expanding prudently? To summarize, in hospital stocks, don't judge valuation just by PE. Instead, use EV to EBITDA as your primary lens and track core operating efficiency and how quickly new capacities are ramping up. Now let's move on to the FMCG sector. FMCG is one of the few sectors where the PE ratio is actually quite useful, but only if you interpret it in the right context, because FMCG companies always command a premium valuation. For instance, HUL, Nestle, Britannia, they all trade at 50-60 PE multiple. Now you might ask, isn't that expensive? So FMCG companies are fundamentally asset light, low debt and high cash flow generators. They don't need to keep reinvesting heavily in capex to grow. Their growth comes from distribution expansion, then product innovation and brand power. That often leads to high return on capital and high profit visibility. Plus FMCG companies generate a lot of free cash. So that becomes an important metric to assess how efficiently they convert profit into actual cash. Let's take an example of Nestle India. It trades at nearly 70 plus PE multiple, but it has a history of steady double-digit earning growth, strong brand loyalty, and pricing power in categories like infant food and chocolates. And it enjoys an ROCE of more than 70%. Plus, it is a cash-generating machine. So while PE is a valid metric here, it must be seen alongside ROCE and earning consistency. Yes, today the FMCG sector is struggling due to high inflation and slowdown in volume growth. So you don't want to buy high PE stocks if their volume growth is flattening or if input cost inflation is eating into margin. Having said this, you won't find FMCG companies trading at a PE multiple of 25-30. With inflation easing out and government focus on consumption revival, FMCG sector can see improvement in volume growth as well as margin, and that can result in better earning growth in FY26. So don't just avoid these fantastic companies thinking that their PE is high. To summarize, in FMCG, PE is okay, but it only makes sense when paired with high ROCE, steady cash flow and consistent earning growth. high valuation is justified only when quality is consistent and durable. Then of course, you need to look at volume growth and earning growth. Next, look at insurance sector. So insurance is one sector that a lot of retail investors find confusing when it comes to valuation. And specifically, we are talking about life insurance companies here. Now, if you try to use the P/E ratio for insurance companies, you'll find that they trade at very high P/E multiple. For instance, HDFC Life has a P/E ratio of more than 90. That too after not much growth in share price in the last 3-4 years. But in the insurance sector, P/E ratio does not really tell you much. Why? Because life insurance companies collect premium today, but the profit from those premiums are spread out over the next 10-20 years. So current earnings are just a small piece of the long-term picture. That's why analysts and institutional investors don't use PE for insurance. The real valuation lens here is market cap to embedded value. Then we break this down. So embedded value is a sum of two things. The net asset value of the insurance company, that is the present value of everything they already own today, plus the present value of future profit from the existing policy they have already sold. Think of it this way. If the insurance company stopped selling new policies today, how much value is already locked in from its existing business? That's the embedded value. And the market cap to embedded value ratio tells you how much premium market is willing to pay over the current embedded value to account for the future growth. Let's look at real example. So HDFC Life currently traded at a market cap to embedded value of around 3 times. That means market is willing to pay 3 times the embedded value of its existing business because it expects HDFC Life to continue to grow at a healthy rate, maintain high persistency and keep acquiring quality customer. Compare that to LIC, which trades at closer to 0.8 times market cap to embedded value. Now that looks cheap, but LIC has different issue. Lower profitability, legacy product with poor margin and a weak private sector distribution model. So the market isn't willing to pay a high premium despite its size. So how do you analyze valuation here? You want to track market cap to embedded value ratio, ideally compare it to peer and historical trend. Second, look at the value of new business, that is VNB margin. This tells you how profitable new policies are. Then third is annualized premium equivalent, that is APE growth. It shows sales momentum. And fourth important KPI is persistency ratio. Basically, how many policyholders stay for the long term. To summarize, in life insurance, ignore PE. Focus on market cap to embedded value and then dig deeper into VNB margin, APE growth and persistency to judge whether a company deserves a premium or not. Now let's move on to the final sector for this video, that is retail. Retail sector is one of the fastest growing and most consumer facing sector of India's economy. In fact, this is one sector we all can directly relate to. Be it jewelry chains like Kalyan or Tanishq, be it Titan, be it Zudio part of Trent, or be it Avenue Supermart parent company of D-Mart. But if you look at the valuation, they all trade at very high P ratio. But P might not show the right picture. Why? Because in retail, especially modern retail, companies go through long gestation phases. When they open store, they spend heavily on expansion, logistics, staff and technology, but it takes time for those stores to break even and turn profitable. So current earnings are often depressed or even negative. That makes the P ratio misleading. Instead, in retail, the market tend to focus on EV to EBITDA, sales per square foot and sometimes even price to sale, especially for fast growing but low margin companies. Let's take Trent, which runs Westside and Zudio. Its P ratio looks insanely high with more than 100 times, but company is in hyper growth mode, opening more than 100 stores a year. What matters more here is, are these new stores profitable? What is the same store sales growth? And how much EBITDA is being generated per square feet? Or take D-Mart for example. It's often valued using mix of EV to EBITDA and revenue multiple. Why? Because D-Mart runs a very efficient retail model with industry best EBITDA margin of around 8 to 9%, while most retailers operate at 4 to 6%. So what should you track while analyzing retail stocks? EV to EBITDA to judge operating profitability without distortion from depreciation and interest. Second is same store sales growth. Are existing stores still growing? Then third is revenue per square feet. It shows retail efficiency. Fourth is store addition pace and payback period. How fast new stores become profitable. And fifth is gross margin trend, especially for fashion and discretionary retailers. Also, if the company is in expansion mode and still not very profitable, like Aditya Birla Fashion or Arvind Fashion, investors often look at price to sale ratio and compare it to peers to see whether the growth potential justify the valuation. Just to summarize, in retail, don't rely only on PE. It can be misleading during expansion. Instead, focus on EV to EBITDA, same store sales growth, and revenue per square feet to understand how efficiently the company is scaling. So to wrap this up, while the PE ratio is the most talked about valuation metric, the truth is it does not work across all sectors. Each industry has its own business model, capital structure, and growth trajectory. That means the way we assess valuation must adapt accordingly. For example, in banks, profits don't tell the full story. So we need to look at price to book and ROE. In insurance, earnings are backloaded, so we use market cap to embedded value. In retail or hospital, where expansion cost suppresses profit, EV to EBITDA tells us a lot more. And in FMCG or IT, where profits are stable and recurring, PE still work well. So the next time you are analyzing a company, ask yourself, what metric actually reflect this business value creation? Because great investors don't just look at ratios, they understand which ratio matter in which context. If you found this breakdown helpful, let me know in the comments. And if you want me to discuss the valuation of any other sector that I missed, like hotel, real estate, etc., let me know in the comments. I'll see you next video. Till then, take care.